The investment objective of the First Trust Vest Income ETF, ticker KNG, is to replicate the price and yield performance of the Cboe S&P 500 Dividend Aristocrats Target Income Index monthly series. The strategy relies on a distinct two-pillar framework, investing at least 80% of its net assets in the common stocks and call options that comprise the tracking index. The base of the portfolio consists of a physically replicated, equal-weighted basket of stocks matching the S&P 500 Dividend Aristocrats Index. Because the portfolio is equally weighted, it eliminates the concentration risk inherent in market capitalization-weighted large-cap benchmarks, resulting in a distinct value, mid to large-cap, and quality tilt. The equity component is rebalanced quarterly to restore equal weighting, effective after the close of the last business day of January, April, July, and October, and is reconstituted annually in January. This equity sleeve is concentrated heavily in defensive, cash flow-rich sectors, such as consumer staples, industrials, materials, and utilities, while remaining structurally underweight in high-beta growth sectors like technology. To generate the target yield, the fund overlays a rolling series of short, written call options. A defining characteristic of KNG's option strategy is its implementation at the individual stock level rather than the index level. The fund writes covered call options against each individual stock held within its Dividend Aristocrat equity sleeve. The options utilized are standardized listed equity options written with a strike price set as close as possible to the closing price of the underlying stock at the time of writing, placing them at the money, ATM. For the tracking index SPATI, these options are rolled on a monthly cycle, specifically on the third Friday of each month, with the subsequent written options expiring on the third Friday of the following month. Unlike legacy covered call funds that write options on 100% of their equity holdings and fully sacrifice capital appreciation, KNG utilizes a dynamic variable overwrite percentage. The strategy calculates the exact portion of the equity portfolio that must be overwritten to meet its precise target income, leaving the remaining portion uncapped to participate in market upside. The target yield parameters have undergone significant structural enhancements over time to optimize cash flow generation. Pre-July 21, 2023, the index methodology was configured with a target yield of 3%, or 3.5% for the weekly rolling SPY index, over the annual dividend yield of the S&P 500 index. During this period, the portfolio overwrite ratio for each stock was capped at 20% to preserve maximum equity upside. Post-July 21, 2023, in response to changing interest rate regimes, the target yield was raised to 8% over the annual dividend yield of the S&P 500 index for the monthly series, SPATI, and 10% for the weekly rolling series, SPAI. To facilitate this higher yield target, the individual stock overwrite cap was increased from 20% to 100% of each stock's holding. Backtesting has demonstrated that achieving the 8% target in the monthly series requires an average equity coverage ratio of approximately 23%. As of May 29, 2026, the fund's option overwrite percentage was 19.12%, corresponding to an upside participation rate of 80.88%. The foundational design of KNG centers on writing call options on individual stocks rather than writing a single composite option on the S&P 500 index. This structural choice is rooted in the mathematical properties of implied volatility and portfolio dispersion. In option pricing theory, option premiums are directly driven by the implied volatility, IV, of the underlying security. Because an equity index represents a diversified basket of stocks, the aggregate volatility of the index is mathematically dampened by the imperfect correlation of its constituents. Company-specific idiosyncratic volatility is diversified away at the index level. Consequently, implied volatility for index options, such as SPX options, is structurally lower than the weighted average implied volatility of the individual stocks within that index. By writing call options on each individual Dividend Aristocrat stock, KNG systematically captures this higher idiosyncratic volatility premium. This enables the fund to generate its target yield while overwriting a smaller fraction of the portfolio, historically around 20%, leaving the remaining 80% of the portfolio unhedged to participate in the capital appreciation of the underlying stocks. While writing options at the individual stock level yields richer premiums, it introduces a severe performance drag during equity bull markets, a phenomenon known as the single stock overwrite paradox. Under an index-level covered call strategy, an investor participates in the upward movement of all constituent stocks, with the portfolio's total value only capped at the index-level strike price. Under a stock-level covered call strategy, the performance cap is enforced stock by stock.
If a single constituent stock experiences a significant positive idiosyncratic event, for example, stock appreciation following an earnings beat, the appreciation of that stock is immediately capped at its strike price on the portion of shares overwritten. The fund is obligated to deliver the stock's appreciation above the strike price to the option buyer, retaining only the option premium.
Conversely, if another constituent stock suffers an idiosyncratic crash, for example falling 15%, the call option written on that stock simply expires worthless. The fund retains the option premium, which provides only a minor buffer against the capital loss. The fund remains fully exposed to the remaining downside of the declining stock. This creates a structural performance asymmetry. The fund's upside is capped on its best performing holdings. The fund retains nearly all the downside on its worst performing holdings. This performance asymmetry explains why KNG has historically underperformed its non-option counterpart, the ProShares S&P 500 Dividend Aristocrats ETF, by approximately 1 to 1.75% annualized over long-term investment horizons. The performance of KNG and its associated fund classes reflects these structural trade-offs. The strategy excels in flat, choppy, or range-bound markets, where option premium income cushions returns and outperforms standard long-only portfolios. However, during prolonged bull markets, the capped upside leads to performance drag. The cost structure of KNG and its mutual fund classes reflects the premium pricing associated with active derivative management. While passive dividend ETFs typically feature low expense ratios, KNG charges an annual management fee of 0.74%. For taxable accounts, the tax efficiency of KNG's distribution model is a critical variable that can erode net returns. The fund distributes monthly cash flows derived from two distinct sources: dividend income from the underlying stocks and premium income from the written call options. Dividends received directly from the Dividend Aristocrat stocks typically meet the holding period requirements to be classified as qualified dividends, making them eligible for preferential long-term capital gains tax rates of 0%, 15%, or 20%. However, the cash flows generated by selling short-term call options are classified as short-term capital gains under U.S. tax law. When these capital gains are distributed to shareholders, they are taxed as ordinary income, which can reach up to 37% federally, plus any applicable state taxes and the 3.8% net investment income tax (NIIT) for high earners. This difference in tax rates introduces a substantial tax drag in taxable brokerage accounts compared to pure long-only dividend growth strategies.
Because the options written are physically settled equity options, there are periods when the fund must liquidate or trade underlying stocks to settle option exercises or close out in-the-money option positions. These transactions can lead to capital adjustments. During periods when the fund must sell securities under unfavorable conditions to settle option positions, the distributed premiums may be classified as a return of capital. A return of capital distribution is not immediately taxable as income. Instead, it reduces the shareholder's tax basis in the ETF shares. Once the investor's tax basis is reduced to zero, any subsequent return of capital distributions are taxed as capital gains. While this defers the immediate tax liability, it reflects a liquidation of the fund's asset base to sustain its target yield, which can diminish the long-term compounding potential of the portfolio's principal. KNG offers a highly structured, systematic framework for yield extraction. It is designed to harvest the implied volatility premium of individual blue-chip equities while protecting a significant portion of capital appreciation through its variable overwrite model. The strategy is less suited for long-term growth portfolios due to its structural upside capping, tax inefficiencies, and higher management fees compared to passive dividend growth benchmarks. Instead, KNG is most effective when positioned as a tactical income sleeve or an alternative asset allocation within tax-advantaged accounts, such as traditional or Roth IRAs. In these wrappers, the ordinary income tax drag is neutralized, allowing the fund's monthly cash distributions to compound more efficiently.